Right, I thought I'd put together a video showing you why there is no need for the moving averages. I I got to a stage a long time ago where all I needed was a naked chart, candlesticks, and that's it. I've put the moving averages back onto the charts purely, really, just to help or sort of talk you through the processes of how I learned trend analysis and stuff. And it all started with a, a shed load of moving averages on charts, and we all thought this was the holy grail because it just uncanny how when one crossed below another one that the price moved. And being a complete newbie and novice, we were told that the big institutions use them, and if you look at films like Wall Street and God knows what else, you'll see a chart with just a couple of moving averages and everyone sell, buy, and all that lot. So it's a very convincing argument. But what does concern me is that they can confuse you, and they can cause you to perhaps go for trades that you wouldn't perhaps normally go for, because you have this belief in the fact that where this has come down, tested this 100 moving average here, then you could easily have been faked into considering it going down to there, in a moment of weakness, or when it's here going down to here, because you've just not followed the rules. You got caught up with adrenaline and so on and so forth. If you're just using the rules, or a set of rules that I've laid out for you, which is trade, grab your 8 or 9 pips and don't worry about the rest of it, then that doesn't become an issue. But greed and fear is the problem with trading. So why not just get rid of all these moving averages? Because as I said right at the start, when I started with this new cleaner template, it doesn't matter what they are. You're probably thinking, well, that's a load of rubbish, but it doesn't. Some people have the 20 and the 40 crossing over. Some people have the 100 and the 30 crossing over. Some people use weird and wonderful numbers, and that's what I mean by that. So they're just like stabilizers on a bicycle, really. They're there for quick identification. Oh yes, yellow's below the purple. Then I should perhaps think about going short. If the yellow's just crossed over the purple, then I should be going long, and that's great, But we wake up in the morning, look at our charts, and look for a crossover, an alert, should I say. So a crossover of the 10 moving average. That's all we need to see, and then we drill down and enter the trade using the low time frames. So let's get rid of these, because they are just a lazy man's tool, if you like. And just look how lovely those charts look, nice and clean now. We could even reduce the size of the arrow. Arrow type, let's go for 2. And we can get rid of the vertical line as well, because as I said, they're only for a reference purpose, really, when I'm looking back on the charts and analysing what's gone on. And there we have a lovely clean chart. And so when you get up in the morning, whatever time of day you happen to start trading, all you have to do is look for a recent alert and then trade accordingly. So in this instance, let's just run through that little trade. I didn't take this one yesterday. The reason being, I think it was hanging around at about with the average daily range at something like 30 pips, and it just didn't seem to want to go anywhere. So I guess they were waiting for some sort of news. But as I said before, I like to take the trade early, and then I'm not sat watching charts all day long and getting caught in trades that I don't want to be, and getting stressed at the end of the week and so on and so forth. So there's our alert. We know we need a pullback. In this instance, we'd had a pullback prior to the alert, and we were at support becomes resistance there and there. We've got the trend in place: high, low, lower, high, lower, low, old support, stick a level on there, acting as new resistance, and that's the mantra. That's just the rules of supply and demand, and the big boys loading up with what we call discounted orders. But that's neither here nor there. So sticking to the rules, we want to pull back after the trigger bar. So we're not interested in entering the trade here, because it should pull back. Those are the rules, and that's it. So we're moving along here, and we've had our pullback there. So now we need a counter trend or a with trend pullback, and that will be our entry. Now we need to check the higher time frame, the 15 and the 30, just to make sure that we haven't moved into a higher time frame. I mean higher than the 5-minute reversal, and in this instance we had. So what do we know we need if we move into that? We need a counter arrow. So we must never trade against a higher time frame alert. Just check the 30 for the last thing. No problems on the 30. If this had been blue here as well, then we would have wanted to wait for a blue over here as well. That's just, you may amend how you enter your trades according to your experience, but that's how I like to explain things. So 15-minute is down. Now we can just fine-tune the entry using the lower time frames, and this is the right thing to do. Drop down on the 1 minute. Don't get lazy. Wait for the 1 minute pullback, or alternatively, when you've had your 5-minute alert, or in this case the 15-minute alert, just put a level on the bottom of the alert candle, and once you get a breakthrough of that low, which is this one here, break of that, you can enter the trade. So either use the 1 minute trigger bar, or just a break of the 5-minute trigger bar low, providing you're not trading against an indicator. In this instance, you would have been until this point here. In the minute you get that, then you can hit it. And as you can see, it's moved a good 20. Well, there's the 25 gap, so we've had 25 pips out of that one, plus potentially, I guess, can't quite read that, 30, 25, another 5 pips there, so that's your spread taken care of. So I'd be out of this trade down here. At the end of the day, tomorrow's another day. And for stops, well, as I've mentioned before, your stop needs to be behind some sort of support, so that when it comes up and tests it, you don't need to put it behind resistance. Here would be a good place to consider a stop. So somewhere around that lot there. This support should protect you against pullbacks. They're running out of momentum to the long side, as you can see. So the entry was roughly 630, and the stop was 646. So add the spread to that, it's about an 18 pip stop and a 25 to 28 pip target, a few extremes. So there you are, and that's how you trade that H1. You'll notice the resemblance. These it's not coincidence that these trades all look the same, and the reason I keep showing you the same setup is to try and make you realize that patterns do repeat and repeat themselves with such regularity. It's just the way the mechanics of the market. then you shouldn't. You should eventually build up some sort of, as long as you're disciplined and you have the patience to wait, like I've done, up, down, up, down, up, down, until all your ducks are in a row, then you're good to go. So there's your chart without any moving averages. Here's a perfectly good entry again during the day, and that's it. Thank you for watching.